Well, happy summer to all of you. We're really glad that you made some time to listen to us. We are going to our monthly calls now because we think that doing these will help us be famous. And so we're hoping we're hoping that you'll enjoy these. We're going to try and keep them tight and short. The subject that we're going to look at today are leading economic indicators. And the question is, what are leading economic indicators saying? And the second question is, can we trust these indicators? What is it? What should we be doing in light of them? So we're going to start out with some leading indicators. Tarek has done quite a bit of data downloading. So he's going to take us off first here, looking at different indicators that he's dug out. And then we'll see, what it might mean for us and our portfolios. Tarek.
Absolutely. And some of these indicators are ones Mark and I definitely look at regularly. And some of them were just, interesting ones that are interesting to keep an eye on and that people have found to be kind of compelling throughout history. So I'll start with the Purchasing Managers Index, So this is the measure of the activity level of purchasing managers in the service sector. And the rating is generally above or below 50. A reading above 50 indicates expansion in the manufacturing sector, and a reading under 50 indicates contraction. And it's based on a monthly survey. And so the outfit that publishes the information does a survey of purchasing managers and sort of says, hey, what are you feeling? What are you thinking? Are you going to be buying more or less? And then, gets a measure of sentiment in purchasing managers. So the current Canadian PMI is 49.6. So, just under 50, very, very close to 50. But as I mentioned, sort of technically in the contraction phase. It was last above 50 in April. And I wouldn't necessarily, if you had to just look at the hard number, you'd say, yeah, it's a negative in the contraction phase. But it's forecast to be up above 50 again by the end of the summer, by the end of the quarter, which is the end of the summer. And it's supposed to be continuing up from there. So that's the Purchaser Managers Index. Again,
so maybe we say that it's in the middle, mixed, soft.
Yeah, mixed.
Not a lot of
that's
indication.
Probably the best way. Yeah.
Good. Next.
Awesome. So the next one, and this is one of my favorites, if anybody's listened to me talk about it before, it's national building permits here in Canada. So construction projects, regardless of the type, residential, industrial, institutional, they need approval from their respective municipalities before they can build, and the dollar value is included in that approval. And so those permits are aggregated at the national level and, put together in one report. So in June for 2023, we see that building permits are up 6.1% month over month from April. Yeah, it's huge. And it's been big all year. But this is a good example where we need to dig into the numbers a little bit. So non-residential building permits are up 20%, but residential building permits are down 7.7%. So we see businesses are excited and spending money, which is huge, which speaks to sentiment, but there's less housing being built. Okay, so it's interesting. What's also interesting is go ahead.
I would say two things on that one. Number one, my guess is that the commercial leads the residential.
Yes.
Because businesses need to. And number two, there seems to be a serious rental housing shortage, serious housing shortage in Canada. My guess is the residential down 7 is going to do some catch up. Anyway, go ahead.
Yeah, I think you're right on that account as well. And there's some more interesting things happening with this number as well. In that institutional building permits are up 67%, but that's because there were 2 hospitals approved, one in BC, one in Quebec. And it just demonstrates you have to dig into these numbers sometimes because hospitals are not going to be approved every quarter, every month. These are very, very big ticket one-off items. And so we've seen this national building permit indicator be strong most of the year. But this institutional number is not going to be this big every quarter because 2 hospitals getting approved across the country is something that's going to be large, but a one-off.
Do you know where those 2 hospitals are?
One in Dawson Creek, BC, and the other one in Quebec. I'm not sure the town, but it made up 60% of the institutional increase, right? And that's a one-off in terms of that. But yeah, still pointing to strong growth there. The next indicator I'll let you speak about. It's the yield curve. The yield curve is
Oh,
actually a pretty popular one
yep.
among. Yeah,
Watched by everybody universally.
yeah,
Basically, what you do with the yield curve is you look at from short term to long term, and typically you'll say that short term is lower than long term,
yeah.
and
These are
that means it's
Canadian bond
positively.
yields.
Yep.
Yeah.
And so it might run from 3 months out to 30 year is the range, or 3 months to 20 year, that type of thing. When it inverts, that's usually sent as a warning signal to say that the market is going to be cooled off by the higher short-term rates. So it has popped up. We know that it's been up there, and it has been forced up. That's how the Fed manages the economy, is by pushing up these short-term rates, and it puts this yield curve into a negative. So the yield curve is negative, very important. That usually indicates the direction of the economy. If it's positive, the economy is going to be expanding. If it's negative, the government is trying to slow down the economy. And so we're still in this contracting stage. And therefore, that is a negative indicator for the economy and for markets. Back to you.
Yeah, and I think just to even put it more simply, you can think of it intuitively because they're bond yields, right? And you can buy bonds. If you buy a 1-year bond, you'll get a higher yield than if you bought a 5-year or a 10-year or a 30-year bond, which doesn't make sense. If you lock your money in for longer, you should get a higher yield on your money. So intuitively, you can see that it's contractionary for the short-term yields to be higher. And so that indicator, I have the numbers here. For example, as of August 11th, the 2-year Government of Canada bond yield, as an example of the short term, 479. And then the 10-year was 365. So, it's just a little over 1% lower. Historically, that's not outrageous, but it's still, a negative or an inverted yield curve. So that is a recessionary indicator. But again, that's only one indicator, and it's the first one that we're showing that's definitely recessionary. And it's important not to rely too heavily on one indicator over another, because we're still trying to predict an unknowable future, right? It's just, Okay, next indicator. This one's interesting. I think people will find this one fun. This is the Big Mac Index, and I am speaking about the McDonald's famous burger, the Big Mac. So this is an indicator that tells you a little bit about currency movements. So it is trying to gauge whether a currency is correct. Two currencies are correct between each other. So it's based on the theory that the same good, a Big Mac, should cost the same amount in each country, adjusting for the currency. Okay. So, for example, the index said in June 2023, a Big Mac cost $7.05 in Canada, and that is compared to $5.58 USD in the US. Okay. So that implied currency, or that implied exchange rate, was $1.26 USD to Canadian. But the actual exchange rate during that time was 132. So it suggests the Canadian dollar is 4% undervalued. So if you're looking for USD, which many Canadians are, if you're looking to go south, you know what? If you can hold off, the Big Mac Index is saying the Canadian dollar is undervalued by 4% and may move up. If you're willing to put a big bet on the Big Mac Index.
It's a good one. It's a good one.
Yeah, it is a good one.
Yeah.
The next one is the price of copper, the copper index. And so I shouldn't say copper index. It's just the price of copper as a commodity. Now it's been called Dr. Copper because copper has a PhD in economics and is always able to predict the future movements of the market. And the intuition behind the price of copper being a reliable indicator is pretty straightforward, in that copper is used in just about everything, most sectors of the market, from factories, home appliances, electronics, power generation. All of it needs copper. And so the price of copper and the demand for copper is a valuable indicator. So we'll see. Current price, August 14th, 2023, is $3.74 USD. It's down year to date from 426 in January, but it's up from the low in 2022. And I'm comparing to 2022 because that was recessionary or correction year in capital markets. Interestingly, the low in copper in 2022 was in October, and that was the low for the S&P 500, and it has been on an upswing. following, or sure, I should say leading the S&P 500 on its recovery as well. So Dr. Copper got the current recovery correct. If we look back to 2020, and I'll publish this graph. So, if you're watching this right now, you'll be able to see the graph. You'll see it led 2020 recession. I'll push it all the way back to 2008. You'll see it led the 2008 recession and subsequent expansion. So Dr. Copper just makes sense, and Dr. Copper knows what he's talking about.
So October a year ago, 336, current price 374, suggesting we're into people are buying more copper and the price is up. Let me go to the next one. One that is sort of intuitive, but it's also not widely known. But we used to follow it when I worked in institutional investing on Bay Street, and that was the cardboard shipment. There's another one that I don't have the numbers on, and that is parking lot fill. How full are Walmart parking lots, or how full is the lineup at Chick-fil-A, and that kind of thing. Cardboard shipments is very interesting because there is a linear relationship to how much goods are being shipped in cardboard, and people have to stock up on cardboard to get their stuff ready before they start to ship. So cardboard shipment is a very important indicator. Cardboard shipment year over year, Q1 to Q1, Q1 22 to Q1 23 is down 12%. Is down 12%. Now, this person that was writing this went through the contortions of trying to figure out how to make that a positive thing. I don't think there's any way to make it positive. It's just to recognize cardboard shipments are down 12%. That means there are fewer goods being made and shipped. There is something else going on, though. And that is where, like Tarek said, you got to dig a little bit in under the numbers to find out, well, what does this really mean? Well, what it means is there was a lot of stuff being shipped during COVID. Goods, sitting at home. I need my weights. I need my, riding bike or whatever it is. I need my e-bike. That's what I want. But, all these different things are being shipped in cardboard during the pandemic. Now that the pandemic is over, guess what's happening? People are traveling. And so the spending is probably doing fine. That's the consumer spending. But the spending right now is on experiences, is on travel, is on services, and people are stocked up already on their goods. I don't think it's a big concern, but it is certainly one to be aware of. Cardboard shipments are down year over year, 12%. I think the early indicators for Q2 are that it's going to start coming back as well. So I think that it's okay, but it's certainly something to have on your mind. Now, you were going to add something here about your favorite musician, Taylor Swift.
That's right. It's I think a good example of how the economy has shifted. Coming out of COVID, I think, this was a unique time in history. It's we have to remember that previous indicators have to be adjusted for the fact that COVID was a unique time in history. So that cardboard was up probably much higher during COVID and now is down. Doesn't mean that there's a pending recession. We need to look a little closer. And I think as an example of how spending has shifted, people are looking for experiences. And Taylor Swift's Eras Tour, for those of you who are fans of Taylor Swift or are friends who are fans or family, is going to be probably the biggest grossing musical tour in history. The average price people are spending to go to the concert, including tickets, hotels, and food, is $1,300 US. It seems that every city she goes in, or every country even, experiences a measurable and noticeable boost specific to that particular event, right? So to Taylor Swift specifically, it's measurable, it's specific. I know in Seattle, they recorded actual seismic activity that they attributed to that, people at the concert jumping and stuff like that at the stadium. It's wild.
I think I read, Tarek, that Denmark saw a move in their national gross domestic product when she had a concert in Copenhagen.
Yeah, I don't doubt it. It's incredible. And the Federal Reserve even mentioned it in their notes, that they're expecting consumer spending to have been bumped by nearly they're estimating $5 billion in the United States just due to this Eras tour alone and the associated spending with it. She's coming to Canada now. I think she has 6 shows in Toronto. And so I think Canada should also expect that commensurate boost because she's only going to Toronto. So we're going to see air travel, hotels, food, just general merch, whatever. And so that's an example. People are spending outrageous amounts of money on experiences, destination weddings are up. It's
Yeah. So, are you going to go?
I am not going to make it. No, I can definitively say that. Are you going to make it?
No. I've got better things. I've got Burton Cummings I want to go see. Okay.
There you go.
What does this have to do with the economy? The point is that there are different events happening. Cardboard shipments are down, but experiences are up. Those are probably somewhat offsetting events. And that's the reason that we would mention, even the Taylor Swift thing. Okay. Anything to wrap up here? And then we want to look at next month.
Yeah, this is the end of the, we're done with the economic indicator episode. We just want to give a plug for next month's episode of Tower Talk. We are going to be talking about timing the market and, how effective that can be or not be. Have to tune in to find out.
We'll look forward to connecting with you then. Thanks very much for all your time.
All right. Talk to you later.